I would like to start off with a confession. Just Speed, how did you get into the area of real estate and finance and taxes specifically in that section?
Started out actually in the hedge fund space at BlackRock down in downtown Seattle.
Never really forget that baseline knowledge. Gifting has become significantly more prevalent than I think it used to be.
So generally, there is no tax on gifting.
23% of first-time home buyers used a gift in 2023.
It goes from cash gift to we are gifting the house at this address to our children.
Parents would like to sell their home to a kid. They want to get some money out of it, but maybe not the full value, right?
Which means the IRS basically doesn't penalize people for death.
Speaking of generational passing of wealth,
They bought 6 acres for $75,000.
hello and welcome back to the Mortgage Lab podcast, where we talk to real estate and finance professionals and other industry adjacent professionals that are going to bring you up to speed on things that you might need to know. And today on the podcast, I would like to start off with a confession. I studied under a guy for a long time who would say confession is good for the soul but bad for the reputation. So here's mine. I am a recovering tax professional. Oof. That felt good to say. So I've let all those licenses go, but in this industry of mortgage and real estate and finance, it's still important to have a good handle on the basics. And so to help us today, we have my dear friend. I'm going to just say that as many ways as I can. To help us today, we have my dear friend, David Brennig, who is a CPA who can actually bring us up to speed on some of the things that become really, really important around real estate and finance. So David, first, thank you so much for being willing to jump on this crazy podcast.
Not a problem. Really appreciate you having me.
Yeah, man, it's good to have you here. So this becomes important. At a certain point, it might be fun to actually go down my beginning in finance history. I counted one time, and I have personally been responsible for over 3,000 tax returns.
Yeah.
Which sounds like a terrible thing to admit.
Yep, that is.
But thank you. You agree.
Yeah, I do agree.
But yet it's an important thing. And that was really my entry into the finance arena. And as boring and terrible as that job was, which I later became a partner in, and maybe at a certain point we can recount my history, but today's not that day, it impressed upon me the importance of getting the tax side of this right.
Right.
And when you start dealing with big transactions like real estate and finance, it becomes even more imperative.
Yes.
Would you agree?
I totally agree.
So
Yep.
Now that I have exited this, you have gotten into it. Bring me up to speed. How did you get into the area of real estate and finance and taxes specifically in that section?
Yeah, so I've got kind of an interesting background.
I love it.
Yeah. Started out actually in the hedge fund space at BlackRock down in downtown Seattle.
No way.
Yep. And then went out and actually coached college football at Eastern Washington
There you go.
for a couple of years.
Yeah.
Just because that was my passion. That was plan A.
Yeah.
Coached high school football for 7 years.
Oh, really? Okay.
Leading up to that. And then came back and went back to BlackRock. They knew if that opportunity arose, I was going to take it.
They were holding the seat for you.
They were.
Okay.
Yeah, luckily. So I came back, and it just so happened that I got back into the hedge fund space. And managing director came to me and said, hey, you should really think about the Big Four. And so I actually went to Ernst & Young and started on the audit side.
Really?
I did.
That had to be interesting.
That was very interesting. Well, audit's not interesting. But realized that I kind of wanted to be more proactive instead of reactive like
Sure.
audits are.
Mm-hmm.
So I switched over to the tax side.
Mm-hmm.
And I was actually married with a kid and one on the way.
Goodness.
And I couldn't do the 90-hour weeks at that point. I was
Yeah.
kind of an older staff.
Mm-hmm.
Went to a regional firm.
Okay.
And then decided to break off and start in on my own.
Do your own thing?
So I've been doing this for about almost 10 years now.
That's great.
Yeah.
That's awesome. And so the cool part about having you here is I've let all my licenses go. You never really forget that baseline knowledge.
Right.
However, like I'm not up to date on any of the newer stuff that's out, and so I'm actually going to do us both a favor. So somebody with a very high hourly rate told me to say this. Here's our disclaimer that shall continue on for the rest of the episode. The following show does not constitute legal or tax advice, and the ideas expressed may be incomplete or may not apply to you. So please consult your financial professional.
Yes.
There we go.
Yeah. There you go.
There's
the plug.
There's the plug. That shall now extend to the rest of the show.
Yeah,
However,
100%.
There are some baseline things that become really important, and especially as you start talking about the role of taxation in real estate and finance, there's some big misconceptions. And so I think one of the reasons I wanted to have you is because I want you to speak to them, because they're so common that I think it could really help out folks who are, curious about the homeownership process.
Agreed.
One of the things that let's talk about gifting.
Mm-hmm.
This has become more of a prevalent topic more recently with higher home prices and higher down payments required and tighter home qualifying ratios. Gifting has become significantly more prevalent than I think it used to be.
Correct.
So, in fact, according to the National Association of Realtors, 23% of first-time home buyers used a gift in 2023.
Yep.
And if you were under the age of 30, that number jumped to 40%. And so let's talk about gifting. One of the most common questions I get is around taxation of gifts.
Right.
So help clarify some of these things.
So generally, there is no tax on gifting.
Thank you.
Yes.
The gift tax is not a thing.
The gift tax just means that you need to file a tax return.
Correct.
And the tax return itself is just informational.
Right.
And so the 2024 limit, where it's like, okay, you need to file a tax return now, is $18,000.
Right.
So somebody could actually give you $17,900 and they don't need to file a tax return.
Right.
As soon as you hit that $18,000 threshold, $18,000 or more, then you need to file a tax return with the IRS. But you're not taxed on it, and neither is the person that you're giving the money to.
Right. And that's really important. There's no tax for the gifter or for the receiver.
Yep. 100%.
Yep.
100%. Now, if you happen to be gifting $13.61 million in your lifetime, so there's basically two exclusions.
Right.
There's the yearly exclusion of the 18, and then you also have a lifetime exclusion of the 13.61 million. Once you get over that lifetime amount, which I don't think you or I have hit that.
Not yet, no.
We're aspiring to.
Yeah, aspiring.
But once you get over that 13.61 million, then it is taxed.
Right.
And the person gifting is the person that's taxed on.
Right, and then that falls really under estate taxes. That's a different deal.
Correct. Yep.
Right. Yep. And at that point, there's a number of other strategies that come into play. And so by the time you're giving away over 10 million, like, you should be talking to somebody
100%
to help you structure things.
Yep.
Now, the other thing that I think is interesting is we'll call it a loophole. It's not really a loophole, but let's say that you have multiple gifts being given. You could have multiple gifts from, say, a husband and a wife to the same child.
Correct.
Right? So talk about that.
So each person can gift up to $18,000.
Right.
Or if the other way to look at it too is if parents are gifting to their children that are married, they can also gift each person $18,000 as well. So, I mean, it's, and they could each gift $17,900 and they still don't have to file a tax return.
Right.
So, yeah, I don't know if you want to go
and
deeper into that or.
For sure. I mean,
yeah.
And we've had scenarios where a couple, in our case, they were getting 4 different gifts. And really the fear was around triggering the tax return. And at least in my experience, like, the form wasn't too bad.
Form's not bad at all.
It was probably, it was a very, very quick form, very straightforward. And it didn't change anything at all. But there was so much fear around that. Have you found something similar?
Yeah, there is a lot of fear around it just because it's a form that nobody's really filed before, generally speaking.
Sure.
So how the form is laid out is it looks like the front page of like a 1040. So So let's say I were to gift my kids $19,000 a piece. So now we're triggering that tax return. So I have my name on there, my wife's name on there, and then we go into it of, okay, who did you gift it to? Put in their social security, their name, their address, how much we gifted.
Yep.
That's literally all there is to it.
Right.
Now, if you go to gift a home, one thing that we have started to see is people moving out of the area down to Arizona, down to Idaho. And I have had a couple of people come to me and say, hey, I don't want to gift cash. I want to gift my house.
Yeah.
Because I don't want my kids to be paying the mortgage rates that we were just
Yeah,
talking about.
Yeah.
And so they're gifting their house, or they're gifting the equity in their house. Then all that changes is the description.
Right.
It goes from cash gift to we are gifting the house at this address to our children.
Yep.
So
let's talk more about that in a second. I want to go back really briefly. So when you're filling out the form, let's say somebody gives $100,000, right? Yep. Really all that does is it's documentation purposes, and it goes against the lifetime bucket of the $13 million, right?
Correct.
Okay. All right, but that doesn't, even though the tax return form is triggered. Pardon the interruption, but I wanted to share something with you. This video is sponsored by the Neo Experience app, and it's our way to help people no matter where they are in their homeownership journey. So whether you already have a home and you're looking to make a move, or whether you're just trying to get on the housing ladder, this app is going to give you a ton of tools to help you reach your housing goals. Now, to access it, you can visit www.homeownersuccessapp.com and sign up there completely free, or you can just check out the link in the description. If you're on your phone already, you can also visit the App Store and download the Neo Experience app, and then just use the activation code Humphrey to make it completely free for you. Thanks so much for watching. Now, back to the video. Still no tax.
Still no tax.
Still working on it.
And
And
still no tax.
most importantly, you still got time to figure it out if you're going to be triggering that $13 million estate tax.
Right.
Yeah.
Yep.
Which, based on what we know, will probably continue to go up every year.
Correct.
Yeah, so you're going to have to outpace that.
It's a very similar form. Not everybody's familiar with it, but it's a very similar form to like a 990, like a nonprofit.
Yeah.
So,
Okay, good.
Yeah.
Let's go to gift of equity, because we've seen this a bunch as well. So let's say, for scenario, parents would like to sell their home to a kid. They want to get some money out of it, but maybe not the full value, right? So let's say it's a $500,000 house. They want to gift $200,000, right? Very kind of them. It kind of does present a scenario where the next of kin get the chance to get on the real estate ladder, but without the full expressed expense of a house, right? So when you're doing a gift of equity, that also wouldn't fall under the taxation, right?
Correct. Yeah,
So-
that's also not taxed. Again, the only thing that changes in that is just the description of what's being gifted. That's all the IRS wants to know is, how did you receive this asset?
Right.
Whether it's cash, whether it's equity, whether it's the whole house itself, like, how did you receive this asset?
Yep.
And then, like you brought up, it does go against that lifetime exclusion. So you gift a house that's $1 million, then, your lifetime exclusion is now the 12.6 million.
Yeah.
So you just kind of eat away at that every time you make a gift. But again, biggest thing is not taxed.
Yeah. Biggest thing, not taxed. Big, bold letters. This is not taxed. This is just something to help out.
Just big flashing like Motel 6 letters.
Exactly,
Yeah.
right?
Yeah.
One of the cool things about when you do a gift of equity, at least what we see, is that you can actually position that gift in a couple different buckets. And so very recently, we probably do this, 6 or 7 times a year. We'll have an interfamily sale.
Yeah.
And you can position a part of the gift of equity as the down payment, and then another part of the gift as a seller credit. And you can effectively have somebody move into a house, no money down, and you can use this seller credit, which is the equity, to buy down an interest rate.
Yep.
And those types of scenarios have been magical for people trying to go and do interfamily sales, because you're into a house and you just use the equity of the house to buy down the interest rate.
Right.
And it's fantastic.
Which
it works
is
really.
huge.
It's huge.
That's huge.
Right?
Yeah.
But that's it's a kind of a very unused trick.
Yeah.
It should be more prevalent for that generational passing of wealth.
For sure.
But it doesn't get it doesn't get used too much.
Yep.
Okay. Speaking of generational passing of wealth, which we're seeing more and more. Let's say, so we have a scenario recently where the aunt has passed away, and the aunt is going to be giving the home to their nieces and nephews. Okay, so the aunt purchased the home 20 years ago for like $100,000, and based on where she is now, it's about 1.2 million. Right? So we've got massive appreciation.
Correct.
Based on that little bit. Okay.
Yep, correct.
So one of the big concerns from the receivers of this house were, and this conversation was interesting. They actually thought it wasn't a gift. They were not looking forward to this because they thought that they were going to give away massive taxes. Talk about that transition in ownership as it relates to whatever taxes might be necessary.
Yeah. Now, did she own the house when she passed? Mm-hmm. Yeah. So she owned the house when she passed. She gets a step up in basis.
So explain what that is.
The nieces and nephews get a step up in basis. So basically, when somebody passes away, like in this situation, we said $100,000 purchased 20 years ago.
Purchased from her parents, by the way.
Purchased from her parents.
So purchased at a discount.
And then when she passed, it was worth 1.2 million. So the nieces and nephews are freaking out because they're like, "Oh, we got to split 1.1 million of this." Correct. Okay. So when she passes away, she gets what is called a step up in basis, which means the IRS basically doesn't penalize people for death.
Right.
So,
which is nice of them.
That is the nice part. Hey,
it's one of the nicer things they do.
Yeah, the IRS does have a little bit of a heart, at least when it comes to that.
A little bit.
A little bit. So that $1.1 million delta,
right,
basically goes away with the step up in basis. So now the IRS looks at it like, okay, that house is actually worth, your new basis is now 1.2 million. So that's what the step up in basis is.
Right.
So when she passes, the new basis steps up to 1.2 million from the 100,000.
So the new cost of the property is 1 point. Yeah.
Right.
Okay.
Now, there's a couple of different scenarios that happen here.
Okay.
Either the nieces and nephews can go and sell the house immediately or within 6 months to a year.
Sure.
And
is that timeline laid out by the IRS? Or
no,
is it
it's pretty ambiguous still. But it's, I would say a year or less is a good general rule of thumb.
Sure.
Anything over a year, you're going to want to go and get an appraisal.
Sure.
Basically proving that, hey, when our aunt passed away, this is actually how much the house was worth. And it's going to cost you probably know more about this than I do, but it's going to cost you a couple grand probably, roughly.
I don't probably know. $700-800.
Okay.
Most of the guys who work on our panel are, this will be very location specific, right? This is Western Washington, greater Seattle area.
Right. So if you're planning on holding it for longer than a year, you want to be able to prove once you do sell the house that it was actually worth the 1.2 million.
Okay.
But if you're going to sell it right away, then there's no need to go out and do that. Or again, sell it under, you're only going to hold it for a year or less.
Right.
And a lot of times, because of that step up in basis, most of the next of kin type people that are getting the house actually take a loss on it.
Really?
Well, because you have closing costs.
Sure.
So, your new basis is 1.2 million.
Yeah.
You're probably going to sell it for about 1.2 million since that's what it's worth.
Right.
And then you're going to have 3 to 6% in closing costs, roughly. So that's a loss.
Right.
So, yeah.
Which is wild because that is not what they were thinking when they came into this.
No.
They assumed that they were going to have an awfully big tax bill.
And I mean, I can even give you a personal example of when my grandpa passed away January 1st, 2020.
Okay.
Not due to COVID.
January 1st, right?
yeah. January 1st, 2020. My grandma, same type of situation. They live in Redmond.
Sure.
And they bought 6 acres for $75,000. Built their house on it, all that kind of stuff. My grandma was very freaked out to sell the house.
Right.
Because she was going to sell it for I think she got 1.25 at the time.
Yeah.
And I was like, no, not only like you get all that money free. You get 1.25 free and clear.
Yeah.
Like, so it ended up being, granted, we miss my grandfather, and like
For sure.
nobody takes away that from anybody, but at least she got 1.2, 25 million out of it.
Yeah.
So, yeah.
Yeah, that's life changing. I mean, nobody wishes for this to happen to
No.
anybody, right? So that's
No.
pretty clear. But there is financial ramifications for any time that this happens.
Correct.
And it's kind of a natural thing.
Right.
So
For
no,
sure.
that's understandable.
Yep.
Yeah, I think that's one of the and I wish that there was more education around this, because a lot of times by the time somebody gets to us and they're looking to do something, they're already completely freaked out.
Yeah.
So
I
let
know
that
we
be
gotta
your
talk them off the ledge.
yeah. So let that be your PSA. Like if you have questions, engage a CPA, engage a financial professional,
Yeah.
engage David.
Yeah.
Let's talk about exclusions.
Yeah.
So home sale exclusions.
Yep.
There is an exclusion which I have opinions about, but when you're selling your primary residence, talk about what you're allowed to gain before you're taxed on it.
Yep. So if you have lived in the house 2 out of the last 5 years, so basically the last 2 years,
Sure.
if you're married filing jointly, you get a $500,000 exemption. If you're single, you get $250,000.
Right.
So we buy a $500,000 house 5 years ago. We've lived in it 2 out of the last 5.
Yep.
We go to sell it for $1 million. We're free and clear.
Right.
We go and sell it for 1.2. Well, we now owe 200,000.
Well, now you owe on the 200,000.
Now you owe on the 200,000.
You don't owe the-
No, you don't owe the full. Sorry, you don't owe the full 200,000.
Yeah.
You're gonna owe long-term capital gains
Right.
on the 200,000.
Right.
So
Now, if somebody, let's say that they lived in the house for a while and they're going to be over that 500,000, but they've done capital improvements. They've done
100%.
roofs, they've done kitchens,
Yep.
they've done bathrooms. Talk about the way that you can include those things in the basis.
Yep. So basically, it's always good to track. I mean, when people get to this point and they're looking to sell their house, especially in this area where they've held it for a little while,
Yeah.
it's hard because people are like, oh, I did my kitchen, I did my roof, I did my bathroom. I don't have any of my receipts.
Right.
I don't know. I have a ballpark of what I spent on it, but I can't really remember.
Right.
So a good way of going back and looking at it is, okay, most people do know when they did,
Sure.
their remodels,
Sure.
it was Christmas of 95. We were redoing the kitchen, or,
Right.
we did the bath in 2000,
Yeah.
so a good way of going back is, okay, like how much was an average remodel of a kitchen
Yep.
or an average remodel of a bath. Okay, we're going to add that to the basis. And adding things to basis is always good because it wipes out gain, which means you're lowering your tax liability.
Yeah.
So,
And here's a shameless plug for the Neo Concierge Service. So the Neo Home Concierge Service through HomeBinder allows you to go and keep a running total of all the contractors that worked in your house and all the projects.
That's awesome.
And when they were done. And so effectively, when you go to sell your home,
Yeah.
not only can you recall that information super easily, but you can print out the entire list of all the maintenance and projects that were done on your home. And it's like you created a Carfax report.
yeah, that's awesome.
Not only do home buyers really appreciate that, but it also is documentation for the IRS.
For sure.
Yeah, so there's multiple reasons to use that.
Documentation is always good. Like if you're seeing this and you know that you're going to do a home remodel or hold on to your house for however long it may be. I mean, documentation is always good, even if it's in an Excel,
Right.
even if you're, I mean, I would sign up for that. That's awesome.
I'll get you on.
But
It's pretty good.
yeah. I mean, even if people didn't want to take advantage of that and just wanted to use like an Excel workbook or whatever, I mean, anything is better than nothing.
Yeah.
But you can also do good faith estimates.
Yeah.
Like if you're thinking about selling your house tomorrow, and you've lived in it for 20 years and you've done all these different projects, good faith estimates are okay.
The IRS
as
is still
well.
okay with that.
Yeah.
Okay.
Yeah.
I'll send you a link anyway. I mean, I pay for it. On
No,
your behalf, so might as well.
no, I think that's awesome. I think people should take advantage of that.
For sure.
For sure.
We'll get you all signed up for the Neo experience. It'll be good.
Cool.
Another thing that we're doing a lot of right now that I think you could bring some clarity to
Yeah.
is for people who purchased in a really low interest rate environment. So they bought in the middle of COVID, they got 2s and 3s on their mortgage.
Yep.
It's effectively free money, right?
Correct.
And so they're wanting to convert those homes to rental properties.
Yep.
Right? And so they're moving on, they're moving up, they need a new bedroom or bathroom, or they're moving out of the area or what have you. Talk about the process of converting your primary residence to a rental property.
Yeah. So, I mean, obviously, you got to go get a renter.
Well, there's that.
Yeah.
Which,
So,
another shameless plug, we've got property managers we work with a lot that do a great job, so we can help with that.
perfect. Yeah. I mean, the biggest thing, at least tax wise, is it goes on your 1040, your individual tax return.
Sure.
And it falls under what's called a Schedule E, which is rentals. And then it also brings in any sort of private placement investments that you may have. It's kind of like a catch-all.
It is a catch-all for
Yeah. So, and then obviously you have to claim your rent as rental income. But then you get write-offs.
Right.
So the mortgage interest is a write-off. The insurance now becomes a write-off, which as a homeowner, it's actually not a write-off. Just the interest and the real estate taxes. Real estate tax is a write-off for rental. Landscaping, if you have somebody come out and do your landscaping or anything like that, or you do it yourself and you have to go get gas or you have to go get a new lawnmower, I mean, that should fall as a write-off. It's keeping up the rental.
Right.
There are things that would need to be capitalized. New roof. If you have to go in and do a kitchen, if you have to do a major anything that's over $2,500, you're going to have to capitalize. Anything that's under $2,500 can be an immediate write-off.
Right. So let's talk about capitalizing larger expenses.
Yeah.
What does that mean?
It means that you can't write it all off all at once.
Right.
That's the biggest thing. So it basically, once you have a rental, you have an asset list. And the first thing that's going to be on that asset list is the house.
Right.
That's depreciated at 27 and a half years. And then you'll probably have land because you should split out rentals with, it's usually 80% house, 20% land, roughly.
So just a perception check. So you're taking a percentage of the cost of the house and a percentage of the cost of the land.
Correct.
Spread out over a 27 and a half year period.
Correct.
Because that's what the IRS has determined is the depreciation period or basically the expiration period of the value of that asset over that time period.
Correct.
Okay.
Yep.
All right.
So then let's say you have to go get a new roof. Okay. That's going to be over $2,500.
Yep.
So that would be, if you have to do that, that would be, go on that asset list. And that's usually going to be a 15-year property.
Sure.
Where it's depreciated.
Right.
So basically you just, over that 15 years, it just ticks, it just ticks down.
Right.
So,
which is actually tremendously helpful as a landlord, because then you don't just take one big loss in 1 year. You can kind of peanut butter that expense over an extended period of time.
Right.
Makes it relatively easy to have properties losing money on paper.
100%.
Right.
But they're not actually losing money generally.
You got it.
Because they're appreciating on paper as well.
Right.
So
the nice part about that is from a mortgage qualification standpoint, mortgage guidelines allow for this, right? You can add back in the depreciation, which is really helpful.
Right.
Or a lot of times big capitalized expenses. Like if you replaced some windows and you've got a big expense in 1 year, even though technically it's being depreciated, you can exclude some of those things because we know you're not buying windows every year.
Correct.
Yep. Interesting. So when somebody is converting their primary residence to a rental, what are the things they should be super aware of going into it?
I would say the two biggest things are if you have it be a rental for more than 2 years, you're going to lose out on that home exclusion.
Right.
Now that $500,000 we talked about earlier.
Sure.
If you're married filing joint, right?
Right.
$250 for single.
Yep.
If you can take advantage of that if you jump back into that rental and live in it again for 2 out of the last 5 years. The only issue is, let's say you have $30,000 worth of depreciation. We're just coming up with some random numbers. if you
Refer to our earlier disclaimer.
Yeah.
Yeah.
So let's say you have 30,000 of depreciation that you took while it was a rental.
Mm-hmm.
Okay, you can't really go back and claim that full $500,000 exemption.
Right.
It's now going to be 470, which is still super helpful. I mean, that's still a lot of gain that you can exclude, right? And you still got, $30,000 tax break.
Mm-hmm.
It's that whole a dollar today is worth more than a dollar tomorrow.
Sure.
You're basically taking that money up front.
Yep.
That's a good way of looking at it.
And an important distinction is you don't have to go and have those 2 years be back to back. You could have them on either end, right?
Correct. You could have them on either end because it's 2 out of the last 5. So you could hop into it and then move away again for a couple of years and then hop back into it for one more year and get that exclusion. But again, and then that's the other thing is that you need to be aware of is you're going to have depreciation recapture.
Mm-hmm.
So, and depreciation recapture is taxed at 25% or your ordinary income, whichever is less.
Okay, so the lower of either.
Yep. So let's say you're in the 22% tax bracket, it's going to be taxed to your ordinary income. Okay. Let's say you're in the 37% tax bracket, you're going to be taxed at 25%. So if you get $50,000 depreciation recapture and you're in the 37% tax bracket, that's all going to be taxed at 25%.
Got it. Okay.
So that's one thing to be aware of. A lot of people, when they go to, let's say they don't move back into it, they're like, hey, we just want to be done with it at this point and sell it. A lot of people just they don't realize that they have to pay tax on that depreciation rate.
Right. Ideally, if they're under 500 or under the 250, like those two things can at least help with that, right? Because a lot of times if it's a short-term investment, maybe you're not quite getting all of that appreciation. So let me ask you this: do you have opinions on moving a rental into an LLC and then claiming it as a business? Or do you see that make sense, or is that frowned upon from the IRS?
Moving it into an LLC, really, it should still go on your Schedule E, because it's still just a rental. It's not a true business. Got
it. So now, if you stack multiple properties, is that where the IRS feels like that's more of a business?
No, I mean, could be. Okay. But it still should go on Schedule E. Basically, anytime it's a rental, I know where you're getting at with this. Real estate professional. Yeah. Yep. So basically, even though it is technically a business, it should still go on Schedule E because they're still all rentals. Now, you can qualify as a real estate professional, which allows you to take all the depreciation, because in this scenario we discussed previously where you're only renting out one, you're limited on how much of a loss you can take.
Correct. And that's called?
That's passive.
Passive activity loss.
Yep. Okay.
So talk about the benefit that if you're a real estate professional, you get by exercising that.
Basically, you get to take all your depreciation on everything. So like you could be making a lot of money and wiping all of it out because of the depreciation.
Now, what would qualify as a real estate professional?
You have to be actively participating in the real estate, like basically day to day. I can't remember the hours off the top of my head just because honestly.
Is that an hour limit now?
There's an hour limit.
Okay.
Yeah. I want to say it's 500 hours at least. But yeah, you have to be actively participating in it to be considered a real estate professional. Yeah.
Now, people like tangential, like mortgage guys, do we get to fall under that as well? Or do we have to hold a real estate license for that?
You have to hold a real estate license for that generally. Yeah.
What are you seeing now with the prevalence of the Airbnb business model? That's a different type of reporting, right? So if you have multiple properties, are you still putting those on a Schedule E? Are they going on a Schedule C, which would be like a sole proprietor business?
Still Schedule E. Yep, still Schedule E. And basically you're having to claim how many days that it was used personally. So basically it just limits how much of a write-off you can take. because if it's only rented out for half the year, the IRS looks at that like, okay, well, you used it for the other half, even though you may not have. So let's say you have a $10,000 mortgage interest payment that you've made throughout the year. You can only claim 5,000. Like they're going to limit you on that. So it's still, I mean, if somebody wants to go out and Airbnb their stuff, like it's still fine. There's just some more limitations around that. And I don't think I actually touched on the LLC part. I think it's a good idea to put a rental into an LLC, mainly for litigation issues, so that they come after the LLC if there is ever an issue and not you personally. Yeah, but taxation wise, it's still going to go under a Schedule E. The only time you really want to shift it over to a Schedule C would be like in your case, right? With like mortgages, like if that's actually your business. And some people out there will be like, well, I have 5 rentals. That's actually my business, but they're still rentals, you know? So
They still operate in a
they're
rental
still
capacity.
operating. Yep. Yep. So let's say you have 3, let's just throw a scenario out there. Say you have 3 rentals down in Arizona and you go, go down there to take a look at them or to clean them up or whatever. You can write that off as travel. Maybe
You get
not
to claim that trip.
Yeah, maybe not the whole trip, like because some of it may be for leisure, but
Book in some spring training time
right,
on either side of that.
exactly. But I mean, if you legitimately like 75% of the trip was for the cleaning up these rentals, you can write that off, and I would write it off across the 3, or if one is making more than the other, like you can write it off against one. I mean, there's different strategies that are fully, legal to do. So
Talk about how important it is for people to engage a CPA before it's tax time, just to get their strategy in order.
yeah, I mean, I think it's huge. I mean, especially in this market where you have a lot of people in the tech industry. People are going to get a lot of RSUs at the end of the year. There's a lot of startups, so you run across incentive stock options, that kind of thing. In my opinion, it's better to always be as proactive as you can. There's always going to be situations where a client may not tell you about something, and you kind of get a curveball. But so in August and July, I have this software called Planner CS, and it's a tax planning software. And the reason why I picked July or August is middle of the year, right? Like we're probably going to be about the same at the back end of the year. And it just gives you a good idea of where you're going to be at. I came across a situation last year where somebody owed like $10,000, and it's like, well, if you would have engaged me like I can't do anything. I'm handcuffed in March, but if you would have come to me in August of last year, I could have showed you like we're going to be low here by about 10 grand. We need to make some payments.
Right, which is the difference between engaging a strategic CPA and waiting and just having your taxes prepared in March or the following year, right? Because you can do things if we haven't run up against the end of the year, which would allow you to avoid penalties and interest and all that. Whereas if you just kind of close your eyes and go, okay, I hope it's going to be all right by the time we get there, you could be in a world of hurt if you don't plan just right. And I want to say most people don't plan just right.
And like, it's kind of a science to it. I mean, even when I'm trying to plan stuff, I mean, I miss it sometimes, just honestly. But we're at least ballpark. Where the goal is to never miss by 10,000. We're hoping to be plus or minus a couple thousand. Like if you're doing that, you're pretty good. But yeah, I mean, that's kind of how I like to deal with the clients that I have, is kind of a holistic approach. I don't want to just plug numbers in. I mean, you might as well just take it down to H&R Block, which not a knock against H&R Block, but you might as well just take it down there and do it. I want to actually plan, plan out how the year is going to look a little bit and try and be proactive, try and be helpful to people. So
The difference in a super solid CPA versus just somebody who's a tax preparer, which I already made my confession,
yeah, right.
so we're good.
Yeah, that's fine.
Yeah, we're good. David, thank you so much for being here. It's been a tremendous refresher, and this is super, super important for people who are just trying to make sure that they have all of their T's crossed and I's dotted as they get into the end of the year. So thank you so much for being here. You want to play a quick game of this or that?
'Kay.
Let's let people get to
Yep.
know you a little bit.
Yep. 'Kay.
I'm going to give you a couple of options. You got to choose one of the
right.
two options, and we're going to go just rapid fire style, okay? All right. So this or that, choose quickly, big city or small town?
Small town.
Morning or evening?
Morning.
Summer or winter?
Summer.
Chocolate or vanilla?
Chocolate.
All right. Dogs or cats?
Dogs.
Movies or TV shows?
Both on that.
You can if you want. I'll give you a pass. Thunderstorm or snowstorm?
Oh man. Can I go both on that one too?
No, I'm going to make you pick. You got to pick that one.
Oh, probably snowstorm.
All right. Breakfast food or dinner food?
Dinner food.
Tacos or sushi?
Man, these are getting harder. Sushi.
Sushi. Pickleball or golf?
Pickleball.
All right, there you go. David, thank you so much for being here. If you'd like to get a hold of David or engage his firm, we will leave all of his information in the show notes. Once again, thank you so much for tuning in. Thanks for watching. Thanks for listening. And wherever you are, please stay curious.